Hello, welcome to live stream. Tonight we are going to be talking about investments, stocks, ETFs, dividend stocks, everything that you want to talk about. Got a lot of friends in here. We just did a live stream on our travel channel, so a lot of them are here already. I see Amy, Ted, welcome, Sarah, Joseph, Philly, welcome everybody. Yeah, Ron's here. Great. That's awesome. Got a lot to talk about. I'm excited. It's been a little while since we did one of these live streams. So I have a couple of topics and stocks that I want to talk about. And then I want to get ones from you that you want to talk about and want to hear about and see. Ted says he's been investing in JetQ and SPYI as an income play. How have you liked that? Yeah, Amy has been on. This is my third live stream of the night. Amy's been on all three. 2 hours of Rob was not enough to enjoy the investment live. Oh, you're crazy, Amy. Yeah, I thought that one of the ways that I would do this is kind of just go over some ideas that I've had and get some ideas from other people and just talk about it. But before we do that, I want to lay kind of a baseline of how I've been double checking the value on my stocks over the last probably about 5 years. I've been using this method, so that's kind of how I look at things. Welcome to the live stream. Yeah, this is only I think our third one, but it's going to be more regularly done now. Yeah, so I'm going to share I've got this set up now so I can share my screen with you and just give you an idea of what I'm looking at, and we can kind of actually look in depth at some different stocks and some different metrics and what looks good and what doesn't. So first thing I'm going to bring up on my screen is I'm going to bring up, this is the tool that I've been using, Fast Graphs. Not a sponsored video by them. I have been paying for this service. But the way this works is basically there's a blue line and an orange line. And the blue line here that you can see is basically that's earnings. And the black line is stock price. And so you can see pretty clearly that for a stock like Coke, which this one is, that the stock price follows the earnings, not perfectly, but it overshoots it, then it undershoots it, then it overshoots it. And you can kind of basically just see that as the stock goes up, as the earnings go up, then the stock price goes up. And so basically the idea here is I check the stocks to make sure that the price is below the blue line. Because if it's below the blue line, you're buying it when it is technically historically undervalued. If you buy it when it's way above the blue line, then you're buying it when it's overvalued. So on this instance here, you'll see Coke. This is a perfect example because Coke is just a very solid, stable company. If you bought it here and then you waited 2 years, which this time is, you're looking at, an annual rate of return of 9.7%. That's probably about what you would get with Coke, and that's pretty easy. And so it's just looking at this, you can see that Coke is very, it's fairly valued right now. So when I look at other things that scare me, why I don't have any Apple stock right now, and I haven't bought Apple stock in years, is because of this. You look at the historical valuation of Apple stock, should be about $162, but it's currently at $278. and they're not really growing all that quickly, 10% a year. So that just makes it a little more risky. So that's the basis for which I look at the ones that I'm evaluating. And yeah, don't look at Palantir then. You kind of have to, if you look at Palantir on this, it almost breaks it, because there's not enough data. First of all, it's not enough years, but it's just crazy. It's way over. Yeah. So one thing that's interesting though is almost all the growth stocks are like this right now. They're all way over, but there are a few that are not, and that have been ones that I've actually been accumulating still this whole year. First one's NVIDIA. When you look at NVIDIA, you can see how that price follows the blue line, basically. And if it were to continue to do so, you'd be looking at 46% annual rate of return, which is definitely better than what it would look like if you looked at the Apple one. So I know that NVIDIA, it's kind of cheating to say that NVIDIA is a dividend stock, because it's a 0.02% dividend. But yeah, NVIDIA is one dividend stock that I'm looking at. David says he believes Apple only exists due to user loyalty. They let Android and Microsoft do all the R&D, and then they just copy their next releases. I do remember when Apple came out with moving pictures a few years ago, and then people were like, that's just video. Yeah, I love Goldman Sachs too. Now, Goldman Sachs is interesting because when you look at Goldman Sachs, it's going to look like it's over, which it is a little. But the thing you have to realize with these banks is that their normal PE ratio has been 12 for the last 15 to 20 years. And so I think there's a re-rating of banks going on. I don't think their PE ratio is going to be 12 going forward due to AI and improvements they're going to make. So I think what's happening is it's always followed this blue line. I think that's going to move up. Still relatively cheap, even though it's over it looks like it's expensive, but it's because the starting point of a 12 PE is so low. Like when you look at these other companies like Apple, that PE is like 30, something like that. So I do like Goldman Sachs. I really liked it a lot more back here in April and March. Would have been an incredible buy back then. So yeah. So a couple others that I am still looking at, dividend paying stocks now we're getting into, because NVIDIA really isn't dividend. And then I want you guys to, if you have any ideas for ones you're interested in and want us to look at, we can do that too. But Realty Income has been interesting for many years because it's done nothing. And I know a lot of people that are in retirement investing, they like Realty Income. They like this 5.53% dividend. And for many, many years, Realty Income tracked the blue line pretty well. Now they've kind of re-rated down. They're under the orange line. I think that's going to come back up once interest rates are cut, which I think they will be next year. So I see Realty Income as a pretty good opportunity. I do need to say, as always, I am not a financial advisor. I'm not your financial advisor. So do not take this as financial advice. Please do your own research and make your own decisions on everything we're saying here. This is a good place for us to throw out ideas. But I like Realty Income simply for the fact that you can be pretty much assured they're not going to miss their dividend. And look at this history of this. There's a pretty good chance that eventually this stock comes back to their normal ratio. If it were to do that, it's a 23% rate of return, and you're getting 5.53% to wait for it to happen. And you can be pretty certain that they're not going to miss a dividend payment because basically they call themselves a dividend company. So I like the risk reward of Realty Income when it's down here. When it's up here above, it's over. No, I don't like that. But when it's down here, yeah, I certainly do like the risk reward for Realty Income. So let's see. Dave said he likes energy and healthcare. Yeah, interestingly, those are two of the. I had a video out about SCHD this week. That's basically two of the main sectors in SCHD, energy and healthcare. And he's saying he's not a buy and hold investor, which I am. I want to make that clear. I am a buy and hold investor. When I say I'm buying Realty Income, I am not buying Realty Income for this week or this month or this year. I'm buying Realty Income for 5 years. When I buy NVIDIA, I'm buying it for 5 years. I'm not selling this. And so my criteria is good company. Where do I think they're going to be in 5 years? I'm hoping to hold everything I buy for 5 years, and then I just don't worry about it. And then I just buy it. And, I bought some things last week. Actually, I bought some Google last week. And then, the next day it went down, which it seems to always do whenever you buy something, right? You buy it, the next day it goes down. But I don't care about today. I don't care about next week. I care about where is Google going to be in 5 years. And Google was one of the Mag 7 that has been a pretty great buy all year. But recently, you can see what happened. We needed to be accumulating Google when there was all this fear of that they were going to be broken up, which gave us March and April of this year was the best time to buy Google in the last 16 years based on its PE ratio, which is pretty amazing. Not anymore, but I still think Google has a pretty good runway in front of it for growth. So I still don't mind Google. Do you trim positions that have run up? I do some. I do. Depends on the position, honestly. But yeah, I do. What I do is I trim it, and then I usually put it into VOO. Which, if you see, Amy was talking about. So VOO is not going to show up on this, I don't think, because it's not an individual stock, and so it doesn't really have. I don't think that the PE ratio will show up. But if you were to do it, I can tell you that it would be if it were to show up, it would be above. So basically, that's saying the market in general is over right now. Because there's more companies that are going to be over this line than under right now. So that's just something to keep in mind. It's been that way for a long, long time because there's so many companies like Palantir and Just companies like Robinhood, Palantir, all these growth companies that have been running wild the last couple of years. There aren't very many that are under. So collectively, the market's pretty high. Let's see. Ted is saying, I have a structure my investments with a 65 to 70% return, seeking 30 to 35% risk reducing portfolio. I like that. Ted. What are some of the, I would be interested in knowing what are some of the risk reducing aspects of it? Because we all get excited about the, going after the growth, but we need to know where we're going to put our earnings to reduce that risk. So I would be interested to know, you or anybody else, where you're seeking the risk reducing. For the first time ever this year, we did invest in gold, GLD, and bought. I remember we were sitting in Kanazawa, Japan, and I just thought, Alan and I were talking about it, and I was like, we had way too much risk in our portfolio, and it was everything had done so well. Everything was up basically in August, and so we just bought a bunch of GLD, and since then it has even though it's been like we bought it for the quote unquote safety aspect of it, it's done better than the growth stocks since then. So that was kind of interesting. Have you compared VOO against VTI? Haven't done that in a video form or anything like that, but we basically just buy VOO because we think it brings a little bit more growth upside and not really that much more downside. It's just a little bit more heavily weighted, I think, to the bigger things. So that's what we've been interested. Ted is saying, generally speaking, bonds are interest sensitive. I have a high income bond fund from Fidelity, FAGIX. Consistent returns, long track record, 5-star Morningstar rating. It checks my boxes. Thank you, Ted. I will check that one out because I am looking to add some of that to our portfolio. Yeah, Joseph, we do have a lot of SGov. That's where we've been holding our money. That's just cash. Holding it in SGov, but it is going down. Yeah. I'm interested in looking up this one that Ted has brought up. I'm going to check that out, Ted, and report back next week with any questions I have on it. Yeah, VOO does have a better return. VTI gives better diversification. We're not super interested in, I think for us, VOO is enough diversification because we're not that risk averse. So yeah, that's what I like about this back and forth is I want to be learning about things that you guys are bringing up too. A couple other dividend stocks. I know I was going to talk about some dividend stocks that I've had my eye on. These I have not bought, just to be clear. But I have my eye on just from the chart of it, and then I'm going to look and see if it's because you have to understand why. Like, why is a company seemingly on sale? If it's for a bad reason, then you don't want to buy it. But if it's for not a bad reason, then yeah. So U.S. Bank Corp, 4% dividend, S&P rating of A. And look at this. So again, as I said, banks have been trading at about a 12 to 13 PE. Theirs has been a 12 PE. And so Goldman Sachs, as we showed you earlier, it's already shot way up. All the other banks have shot way up. If you look at JP Morgan, same thing, shot way up. USB has not shot up yet. So if it does what the other banks are doing, you'd be looking at a 28.89% rate of return and the 4% dividend. Now, like I said, I have not done the research on this to know, but is on my watch list of things to get to know because, like I was saying, the other banks are moving. They're all going up from the blue to the orange, and that's just what's been happening. So I think that's going to keep happening, but I don't know. I haven't done the research on USB yet, but it is one that's on my watch list. Another one on my watch list is Constellation Brands. 2.8% dividend. It has really been hammered this year. You can see for the last 16 years, it has basically followed, for more or less, this blue line. And then all of a sudden it just diverged. And so you need to look at the reason. There are reasons it has done that. Their sales have been low due to a lot of reasons. But if you think it's going to come back, this is the time to buy it. It's been that way for all the stocks in this sector. So again, even if it just comes back to what would be considered fair value from here and doesn't even go back to the blue, that'd be 18.12% with a 2.87 dividend. So a little more risk in this one. Again, have not bought it, but I will be looking at it with a little more interest. Let's see. Yeah, it is in a big correction. So the question is, where will it finish? That's what we'd all like to know, right? Now, another one. So you know the whole Ozempic thing? This is where you have to be careful with stories, because this is a cautionary tale, but now it may turn into a good buying opportunity. So Ozempic, which is basically the weight loss product, is put out by Novo Nordisk. That's hard to say. And this is a wild chart right here. So you can see that for many, many years, it just came along following the blue line, had a little downtime there, but it basically followed the blue line. And then Ozempic came on the scene, and it just shot up like crazy. Even though the earnings did not justify what the price did. The price was way up here. The earnings only went to here, okay? By the earnings, it should have never gone above $71, but it actually got up to $142, double what it should have. And when that happens, when you see it like this, it is preparing itself for a fall. But when it falls, it almost always overcorrects, and it almost always goes right through what it used to be and then goes even down below this. So now this is the cheapest relative time you could have bought this company ever in the last 16 years. So that is not to say what their future prospects will be. You'd have to know what those are and feel good about that, which I don't know that I do yet. But it is another one that I'm going to look into simply based on this chart. You don't want to be buying things when they're like this. You want to be buying when they're down here. If it were to come back just to the blue, which it's done for the last 16 years pretty consistently, 43%. with a 2.5% dividend, AA rated. What's interesting is that people are worried about Ozempic, like, oh, maybe Ozempic's going to go away, or maybe they're going to lose out on that. They didn't have Ozempic this whole time, okay? They didn't have it. And that they were worth, this 25 PE. Now they have it, and now they're only worth 13? It doesn't make a lot of sense. So that is interesting, because that's the kind of things that I look at. Yeah. Now Lily, yeah, Amy's saying Lily. Oh, you can't see that? Oh, sorry. I didn't add it. Okay. I'll do it again. Sorry. This is the chart for Ozempic, Novo Nordisk. Okay, so all this time, it's been following this line, and then this Ozempic. This is when obviously Ozempic came on the scene. It went way up here, and now it's overcorrected way down. So you're telling me that now that they have Ozempic, it's worth 13 PE. But back here when they didn't have it, it was worth 27 PE. Doesn't make sense. Feels like it should at least go back to the blue line where it's been the last 16 years. That's 43%. So that doesn't make a lot of sense. And it's based on the fact that people think that Eli Lilly is doing better than Ozempic, which you guys know. Is Eli Lilly's weight loss drug better than Ozempic? I think that's what's causing this terrible drop. But again, they didn't have Ozempic this whole time. So it shouldn't matter, because the opposite is true, I think, of Eli Lilly. Look at that. See, this is like Ozempic was a year ago, way over. I don't want to be buying that there, because although they are supposed to have profits, you would basically just be flat in 2 years, but I don't want to be flat for 2 years. So which one is the better buy, Eli Lilly or Novo? I think Novo. Better dividend too. So again, not one that I have bought, but it is on this one is definitely on my watch list. Okay. Sorry that did not show up earlier. Yeah, Lily does own that. Amy is kind of an expert on these. She has a YouTube channel on Ozempic and Mounjaro. Yeah. The more they look at GLP-1, the more uses they find for it. Begin with people with dementia and various trials. I just don't see how this NVO is a bad buy when the history, it's always been rated here, and now they're saying it's the cheapest you've ever been able to buy it. So yeah. So, but that is the thing. Lilly released a superior product. It is better. But what they can't tell you is who's going to have the superior product 2 years from now. So that's the big question. You want to buy, like, Lilly is a superior product, but that's why the stock is overpriced. And does that mean that Novo is going to completely lose all their profitability? No, they have a lot of other stuff they're doing. There's a lot of other choices. So I don't know who's making that. Yeah. Yeah. NVO had a recent Alzheimer drug failing. That is the kind of thing you need to look into. But it's also the kind of thing that is a buying opportunity, possibly, if you don't think it'll affect them that much. So again, one that I'm looking into. Have not bought it, but looking into it. Yeah, it's crazy. Like it's a cautionary tale though. Why you don't want to be buying up here. If you bought up there, it is down 50% a year, 65% total. And I see one that's way, way, way above like that, it does not go on my list. Walmart or Target. Yeah, they're very, very different. Walmart and Target. Let's look at both of them. I'm pretty sure Walmart is overpriced and Target is questionable because Target's had some problems, but let's look at them. Target. Target looks undervalued, but I don't know how good the business is. That's the question. Credit rating is still A, 4.9% dividend, 7% growth this year, 8% the next year. That all sounds good. Let's check out the other great thing you can do with this is you can see their free cash flow and their operating cash flow. So this yellow line here is the dividend. So we'll see operating cash flow is here. And it's well above that. So operating cash flow covers the dividend. Let's see if free cash flow does not. You can see the free cash flow is right at the amount of their dividend payment. So ideally, you'd want to see both of those well above the dividend to know that it was completely safe. That is a pretty high dividend. But it's one of those things that if you believe in Target, it's probably not a bad time. Because if it's basically tracked this for its entire history. If it were to go back, that's 20% a year with a 5% dividend. I just don't know that I believe in Target as a business. But I have not been in the United States for years, so I haven't been in a Target. You guys tell me, is Target good still, or are they going out of business? That's the question. Are you buying Sears or Kmart, or are you buying Walmart? That's the question you have to understand. The charts are all great, but you got to know the business. Walmart, on the other hand, this is a disaster in the making. This is horrible. This might be the most overpriced stock of all stocks. I wouldn't touch this. I mean, the blended PE is 44, okay? It's basically traded at a 15 or a 20 the entire last 16 years. And now it's way up there. Blended PE of 44 for Walmart when they have 5 and 12 and 10% growth. That makes no sense to me. Like that's like you're getting into like Nvidia levels of PE with Walmart. So yeah, if Walmart has one bad quarter, this will drop back down to the blue line. I mean, it's crazy. That I hadn't looked at it because I've known it's been overpriced the whole year, but I haven't looked at it in a while. This looks just like Novo Nordisk before the drop. So yeah, 44 PE for a retailer. That's insane. If I had Walmart, I would sell all of it because that's very expensive. LTC Properties, Senior Living REIT. Let's look at LTC Properties. I did used to have two REITs, but they weren't senior living. Let's see. LTC Properties. I've never heard of this, so I don't know anything about it. I mean, it looks fine. It's about, as you know, it's down here at the fair value ratio. They're not going to grow much, 1%, 4%, dividend of 6%. It looks honestly about like Realty Income does. Realty Income is a little bit cheaper. It's a different thing, though. This is a healthcare REIT. Realty Income is, commercial. Yeah, it's not like terribly overvalued, but I don't know if it's a good company. So this chart is called Fast Graphs, and it's not free. It's a subscription. But it's amazing. Like every time before I buy any stock, I look at this, just because you want to know, like, are you buying at a good time or not? So I think it's like $20 a month, maybe something like that. I do have a link in the description for it, if you want to know. And there's a code. I think there's a code in the description. They gave me a code for it, so it is very much worth it. Like if you have hundreds of thousands of dollars in the market, or even 50,000, you should be making decisions based on data, and it's easy. The whole thing, it makes it easy. Yeah, Pepsi has been a good buy most of the year. That's what I've bought Pepsi this year. We did Coke earlier. We'll do Pepsi. Pepsi, yeah, it's pretty much below. Now, the question for Pepsi is that, for me at least, it's A+. Pepsi's not going anywhere, but the PE ratio of 21, a little high to begin with, if you ask me. So I feel like this is more what Pepsi's worth, but it's probably fine. I liked it better earlier in the year when it was down at like 130. But it's probably fine. 3.92% dividend yield. I don't think you won't go wrong with Pepsi buying it now and holding it for 5 years. So, yeah. What is this? Robinhood says 93% buy on Walmart. Yeah, that's the thing is there's two very different types of investors. I mean, there's a lot of people that are trading, and they're buying short term, and the odds are Walmart will keep going up, because why wouldn't it? People are just going to keep piling into it, but eventually the music is going to stop on that, and it's going to come down. So the question you have to ask yourself is, are you smart enough to know when to get out? Do you want that stress? That's not stress I want. So when I see something that's that high, especially for something like Walmart, I get out of it. I did own Palantir this year, and let it run. It was the same thing, but it's a much different stock. Ted says steering clear of commercial real estate or any fund with office buildings, too many vacancies. Yeah, definitely the office thing is bad. Commercial, that's what I wonder about Realty Income. What do you think about Realty Income, Ted? Do you think they're in trouble, or do you think they're gonna come back? Yeah, that's the difference. Like when David's talking about stuff he's doing, it's momentum plays. What I'm talking about is buy and hold. So a momentum play, like currently Walmart is a momentum play. It's going up, and it's definitely going up, and it may keep going up. But there's absolutely no way that the fundamental business is worth what you're selling it at. So it's not what I'd call a sleep well at night retirement stock. You better be watching that, because one bad quarter, like someone else said earlier, and that thing is going to tank. So you have to be on top of it. I just prefer to buy stocks that I can buy. I know that I bought them at a good value. I feel confident the company's going to do well, and I'll check back in on them in a year and see how they're doing, because I don't check every investment every single day because of that. So let's see. What was did I do yours, Brenda? I must have missed it. Oh, Pepsi, I think, yeah. Yeah, I just have the base plan on Fast Graphs. I don't think you need the bigger one, because that's just got a bunch of stuff you don't need. This, I'm only on the basic one. Micah, do you mean Parker Hannafin? Is that what you mean by PH? I think they've done pretty well lately because of AI. Let's see. I haven't looked at it in a while. Ooh. Yeah, they have done pretty well. I mean, it's another one of these that might, the good news for it is that the PE ratio started out low, okay, but now it's currently at 30, which is more valuing it like a tech stock, but it's an industrial stock, so that's a little bit scary. High valuation. Yeah, I have had Main Street Capital. Yeah. What do you think about? I do agree with the work from home schedule, but what about like Realty Income, where they basically own Home Depot, Walmart, Dollar Tree, things like that? Those basically aren't going out of business. They only own like stores. I think they do have some movie theaters, which could be problematic. Yeah, but the definitely the office building ones I think are terrible. Yeah, I think Parker Hannifin was overvalued. I did have some of that earlier in the year, and then I sold it. Probably should have kept it, but again, that's the thing of, do you trim when it gets to be high, or do you, I generally start trimming once I see the valuation getting up, because I don't want to wait for the collapse. So that is what I usually do. I'm trying to see if I have any other stocks I wanted to look at. That was about all I had. Yeah. I was invested pretty heavily earlier. If you saw my earlier, videos earlier, sure, I was invested in all these Cat, Parker Hannifin, and several others. I think they've all gone up quite a bit. That doesn't mean that they're bad, because it's kind of like a re-rating of them, but I'm a little bit Actually, it'd be a lot of it now. Cautious. I didn't realize it'd gone up that much again. Caterpillar. That's the problem, is that these are trading like tech stocks now. It's Caterpillar. 32 PE. I'm not telling you it won't keep going up, but I'm just telling you eventually it will stop going up. And when it does stop, it's going to come down. Unless the whole industry re-rates, which maybe it will. Now, the actual data centers, the one that I have had, somebody was asking about the data centers. Linda, the one that I have had, still have, is Cipher, CIFR. They've partnered with Google. I've never actually even looked at the chart on here for it because I didn't care. Because they don't even have earnings yet. It's more of it's a different kind of play. We shall see. They are building data centers, though, and leasing them to big tech companies. Joseph says his take on O is higher lows in January, April, November 25. Hold or add on weakness. I do like O. I don't have a lot right now, though. Yeah, Cipher is high risk. It could be high reward, though. It's at least, this is the difference. Like, at least it's high risk, but there's high reward. Like Walmart's high risk. I don't see any way it could be high reward. Walmart's not going to like triple. That's the problem with some of these stocks like Caterpillar is, what would it take for Caterpillar to triple? Okay. Cipher could triple in a month. In fact, it has. I bought most of my Cipher at about $7 back earlier this year. So I basically just held everything I bought at $7. Right now, I don't know that I like the price. A week ago, it fell to 13. I didn't actually sell my Cipher then. I actually bought more. It was about 13.90, 14. Now again, it's up at 20. If it came back down to 14 again, I would probably like it again. I really liked it at 7 though, but now the risk is a lot higher because it's going to take a lot more for it to double. From 7, it's already doubled twice, or tripled. Yeah, it's definitely in my high risk play, which is not a huge portion. So, thanks, Brenda. Yeah, I probably need to get going too because I am in Bangkok time. It is 1:30 in the morning. Not that I'm going to bed yet, but appreciate everyone jumping on here. It was a lot of fun. I'm going to check out some of those ones that you guys suggested and report back next week. I'll try to do this again next week and see if we can do it again. So that is the end of the 3 live stream Live-a-Palooza, and hope everybody has a great rest of your weekend and great December. So see you guys next week. We'll be back with our Travel Channel one before, and then I'll probably be doing this one after again. Thank you so much. Appreciate it. Had a lot of fun, and see you next time. Bye.